One bank just cut its own gold forecast by 25%. In under 1 month, no war broke out, no mine collapsed, no central bank stopped buying. Just 2 words buried inside a research note: real yields. And those 2 words trace back to one man in one building in Washington. While JP Morgan was quietly slashing its number, another bank, looking at the exact same data, the exact same Fed, the exact same testimony, was pointing $700 in the opposite direction. 2 of the smartest trading desks on earth, staring at the same numbers and coming to conclusions that don't even belong in the same conversation. So which one is wrong? Or is there something neither of them is saying out loud? Stay with us, because by the end of this, you will understand exactly what these banks are really betting on. And it has almost nothing to do with gold at all. Before we continue, if this is your first time here, welcome to Stick Zennn. Now, I want to ask you for something, and I want to ask it the way you'd ask a good friend for a favor. Not a stranger, a friend. If you found even 1 minute of this useful, just reach over, tap that subscribe button once. It costs you nothing, and it means everything to us. Think of it like keeping a good newspaper delivered to your door, except this one comes to you for free. Every single time the story changes. And one more thing I'd love to know: where in the world are you watching this from today? Drop your city, your country, down in the comments below. It always means something to us to see just how far this story is traveling. Now, let's get back to it. On July 3rd, 2026, something unusual happened inside JP Morgan. One of the largest banks on earth quietly cut its own gold forecast, not by a small amount, but by 25% in less than 1 month. Just weeks earlier, the bank had told its clients that $6,000 an ounce was the number to watch by the end of the year. Now, that number was gone, replaced with $4,500, and the bank's outlook for the third quarter dropped even lower, sitting near $4,300 as an average. This is not normal behavior for a bank like JP Morgan. Banks with this much research power, this much data, this many analysts, do not swing their forecasts by such a large amount in such a short time, unless something underneath the surface has genuinely shifted. So, what changed? It wasn't a war. It wasn't a mine shutting down. It wasn't a central bank stepping back from buying gold. According to JP Morgan's own analysis, the answer comes down to 2 words: real yields. The bank explained the relationship in exact terms. For every single basis point that 10-year real yields rise, gold has been falling by roughly $20 an ounce. This pattern has held since late February. $20 for every basis point, compounding again and again. Think about what that actually means. Gold's price right now is not being driven mainly by headlines, or by dramatic news stories, or by fear in the markets. It is being driven mechanically, quietly, number by number, inside the bond market. And at the center of that bond market sits one man, Kevin Warsh, the new chairman of the Federal Reserve. Since he took the chair in May, every word he has said, every testimony he has given, every hint about future policy has moved real yields, and every move in real yields has shown up almost instantly in the price of gold. This is the part that should concern anyone holding gold or thinking about buying it. JP Morgan's own report lays out what could push gold even lower, breaking below $4,000 and testing a range as low as $3,500. But the bank is clear about something important. This is not their main expectation. It is a tail scenario, something possible, but not the most likely outcome. For that scenario to happen, 2 things need to occur together: hotter than expected economic data during the summer, combined with an early rate hike from the Fed, not one of these alone, both at the same time. And here is what makes this moment so tense. Both of these conditions are already forming. Energy prices have been rising, feeding into inflation numbers, and Warsh has told Congress directly that his committee has zero tolerance for inflation running above target. JP Morgan did not build this downside scenario from nothing. They built it around the exact same pressure building inside the Federal Reserve right now, heading into a meeting this week, and a possibly more important one in September. But here's the detail that changes everything about how this story should be understood. JP Morgan has not turned bearish on gold overall. The bank's long-term view remains fully intact. They still expect a new upward cycle to begin in 2027, driven by central banks moving away from relying on any single currency, and by what they call real yield normalization. In simple terms, once the uncertainty around the Fed settles, one way or the other, the bank expects gold's bigger story to continue. So JP Morgan is not saying the gold story is over. They are saying the next 6 months will be rougher than expected, specifically because of what is happening inside the Federal Reserve right now, and that is only the beginning of the story. because JP Morgan is not the only major bank with an opinion here, and the other banks are not nearly as cautious. While JP Morgan was busy cutting its own forecast, something strange was happening across the rest of Wall Street. Nobody else seemed to agree with them. UBS, in a note dated June 26th, set its 12-month target at $5,200 an ounce. That is $700 higher than JP Morgan's fresh number. $700. Between two of the most respected commodities research teams on the planet, looking at the same Federal Reserve, the same testimony, the same rate hike odds, and walking away with completely different conclusions. UBS described the structural gold market as fully intact. They still expect central banks around the world to buy somewhere between 750 and 1,000 tons of gold this year alone. They acknowledged the same pressure JP Morgan pointed to, the elevated real yields, but they framed it differently. To UBS, this is a moment for patience, not a reason to expect meaningfully lower prices. UBS even laid out an upside scenario. If geopolitical tensions escalate further from here, gold could reach $7,200 an ounce, a number that would represent one of the most dramatic moves in gold's modern history. Now sit with that gap for a moment. JP Morgan's base case, $4,300 by year end. UBS's base case, $5,200 over 12 months. Same data, same Fed, same testimony, different worlds. And they are not the only two voices in this room. Goldman Sachs sits at $4,900 for the fourth quarter. Bank of America projects $4,800 over the next 12 months, with one of their own analysts flagging a scenario that could send prices as high as $8,000 by 2027. Deutsche Bank sits at $4,800 as well. Morgan Stanley has two numbers on the table, an upside case of $5,200 for the second half of the year, and a more cautious base case closer to $4,400. 5 major banks, 5 different views, one shared source of information. So what does this actually mean for someone deciding what to do with gold right now? For a short-term trader, this is a dangerous environment. Every testimony from Warsh, every policy statement, every hint about the next meeting has the power to swing real yields and swing gold's price along with it. JP Morgan has already shown that this relationship is measurable, roughly $20 an ounce for every basis point move. That means short-term traders are no longer just reacting to gold. They are reacting to bond market signals moving in near real time. Whipsaw moves become the norm, not the exception. But for a long-term holder, the picture looks very different. Every single bank in this comparison, whether cautious or bullish, agrees on one thing. The deeper drivers underneath gold have not gone anywhere. Central bank demand, currency diversification away from any single reserve currency, ongoing fiscal concerns across major economies. None of these 5 banks are arguing about whether these forces are real. They are only arguing about timing, about how rough the road gets between now and the destination, not about the destination itself. There is one more asset worth mentioning here, one that rarely gets the same attention as gold, but moves through the exact same storm: silver. Silver carries the same sensitivity to real yields that JP Morgan has now measured for gold. But it carries something extra: heavy industrial demand, tied closely to the artificial intelligence infrastructure boom currently reshaping parts of the global economy. When banks argue over whether gold falls $20 per basis point or climbs toward a $5,200 bull case instead, silver has historically shown up on the more extreme end of that same argument, amplifying whichever direction the underlying uncertainty finally breaks. So here is where this story actually stands right now. 5 of the most sophisticated financial institutions in the world, looking at identical information, cannot agree within $700 an ounce on where gold is headed by year end. And every single one of them points to the exact same reason for that disagreement. Not mine supply, not jewelry demand, not any of the old fundamentals that used to anchor these forecasts. One man, one building, one Federal Reserve. And the real question is not which bank is right. The real question is what all of them are actually betting on underneath the surface. And that is where this story goes next. Here is something almost nobody covering this story has said out loud. These forecasts are not really about gold at all. Every single number, 4,300 from JP Morgan, 5,200 from UBS, 4,900 from Goldman, every one of them is actually a bet on one single question. Does Kevin Warsh's Federal Reserve actually deliver on its own tough talk? Or does something softer happen instead? Warsh has called himself a chairman with zero tolerance for inflation above target. He has said it publicly, in front of Congress, on the record. But inside the Federal Reserve itself, commentators have started calling it something else. A family fight. Some policymakers want to hold firm. Others are worried about slowing the economy down too much, too fast. Nobody outside that room knows which side wins. not JP Morgan, not UBS, not Goldman, not Bank of America. What every one of these banks is actually doing, whether they admit it or not, is placing odds on how that internal fight ends. JP Morgan's more cautious numbers assume Warsh's hawkish words turn into real, sustained policy. UBS's higher numbers assume the opposite, that pressure from a slowing economy eventually softens that stance, the way it has with previous Fed chairs facing similar splits inside their own committee. This is why JP Morgan's forecast moved so fast. Their original $6,000 target was issued on June 9th, just before Warsh's very first meeting as chairman. At that meeting, he cut the Fed's usual policy statement down from 341 words to just 130, a much shorter, sharper message than markets were used to. And the meeting revealed something else. 9 out of 19 policymakers were already leaning toward a rate hike. Then came July 3rd, the day JP Morgan slashed its forecast to 4,500. That date sits right between that meeting and Warsh's blunt testimony to Congress on July 14th, where he called the Fed's own past policy framework a mistake and promised zero tolerance for inflation going forward. Every one of these events happened inside the exact same narrow window where JP Morgan's forecast dropped by 25%. That is not a coincidence buried in a footnote. That is the bank's own stated formula. $20 an ounce for every basis point, playing out in real time, against a Fed that has been generating exactly this kind of uncertainty since May. Now, here's the part worth sitting with carefully. If a 25% swing in one of Wall Street's most respected gold forecasts can happen inside a single month, purely from Fed communication, what happens between now and September, when many analysts already expect the real disagreement inside the Federal Reserve to finally come to a head? This is also where JP Morgan's true downside case becomes clearer. The bank has said gold could break below $4,000, testing a range as low as $3,500 to $3,600, but only if two specific things happen together: hotter than expected summer economic data and an early rate hike from the Fed, not one alone. Both at the same time, and both of these conditions are already forming in plain sight. Energy prices have been climbing, feeding directly into inflation numbers, and Warsh has already told Congress exactly where he stands on inflation, running above target. JP Morgan did not build this downside scenario from imagination. They built it around the exact same pressure building inside the Federal Reserve right now. There is one more piece of this puzzle that deserves attention: silver. Silver shares the same sensitivity to real yields that has been driving gold's swings, but it carries an extra layer: heavy industrial demand, tied closely to the artificial intelligence infrastructure boom currently reshaping global supply chains. When banks argue over whether gold falls sharply or climbs toward $7,200 in an upside scenario, silver has historically moved further in whichever direction that argument breaks. So here is where this leaves anyone trying to make sense of these numbers. Every forecast on the table right now, cautious or bullish, is really a hidden bet on Kevin Warsh, on whether his words become real, sustained action, or whether they soften once an actual slowing economy applies real pressure. Nobody knows the answer yet. But everyone, every bank, every analyst, every serious investor is about to find out together. And that answer is closer than most people realize. After 3 parts of disagreement, something unexpected happens. All 5 banks suddenly agree. JP Morgan, UBS, Goldman Sachs, Bank of America, Deutsche Bank, Morgan Stanley. Every single one of them looking at the same uncertain Federal Reserve, the same choppy short-term outlook, the same real yield pressure, still arrives at the exact same conclusion about gold's long-term future. The structural case remains fully intact. This is worth pausing on, because it is easy to miss in the middle of all the noise. JP Morgan may be cautious about the next 6 months. UBS may be more confident. Goldman, Bank of America, Deutsche Bank, and Morgan Stanley may all sit somewhere in between. But not one of these banks is saying gold's bigger story is over. Not one of them is walking away from the metal entirely. So what exactly do they all agree on? The first pillar is central bank buying. According to UBS's own figures, central banks around the world are expected to purchase somewhere between 750 and 1,000 tons of gold this year alone. This is not a small trend. This is sustained, large-scale demand, coming from institutions, not individual traders. The second pillar is diversification. Countries around the world have been steadily moving away from relying too heavily on any single reserve currency. Gold has become one of the primary tools used in that shift, a way for nations to protect themselves against being overly dependent on one currency's fate. The third pillar is fiscal concern. Across many of the world's largest economies, government debt levels and spending patterns continue to raise questions that show no clear sign of resolving on their own. This uncertainty does not disappear once a single Fed meeting ends. It sits underneath the market for years, not weeks. And then there is a fourth point, one that Bank of America's own analysts have specifically raised. Historically low investor gold allocations. In simple terms, most everyday portfolios and institutional funds are currently holding far less gold than they have, on average, in the past. This means something important, even without any dramatic new event, even without a crisis. If these portfolios simply move back toward normal historical gold levels, that alone could create meaningfully higher demand. From a starting point, most investors do not currently understand. So when all four of these pillars are placed side by side, central bank buying, currency diversification, fiscal concern, and low investor allocation, a clearer picture begins to form. The disagreement between JP Morgan and UBS was never really about whether gold's long-term case is real. Every bank in this comparison agrees that it is. The disagreement is entirely about timing, about how much short-term pain, driven by Federal Reserve uncertainty, investors need to sit through before that long-term case shows up clearly in the price. JP Morgan believes that pain runs deeper and lasts longer, potentially stretching into 2027 before real acceleration begins. UBS believes the pause is shorter, with meaningful upside already possible within the next 12 months. Neither bank is guessing randomly. Both are watching the exact same event unfold in real time, a Federal Reserve under Kevin Warsh, caught between hawkish public statements and quiet internal disagreement. And both are waiting for the same answer. Does Warsh's zero-tolerance stance become real, sustained policy, or does it soften once economic pressure builds? For the business community, for young entrepreneurs, for anyone making decisions based on where capital should sit right now, the lesson here is not which single number to believe. The lesson is understanding what kind of environment this actually is. A short-term environment shaped almost entirely by Federal Reserve communication, where every testimony, every policy statement, every hint about the next meeting can move prices sharply. Sitting on top of a long-term environment shaped by forces far bigger than any single meeting, central bank behavior, currency shifts, and fiscal reality that unfold over years, not weeks. 5 major banks, 5 different short-term numbers, one shared long-term belief, and one open question still sitting at the center of all of it, whether Kevin Warsh's Federal Reserve holds its ground or eventually bends the way others have before it. Nobody has that answer yet. But every one of these banks, and everyone watching this market closely, is about to find out together.